There are a lot of signs of recession or coming recession. Now, I know GDP was very solid for the third quarter, and, Atlanta Fed GDP tracker, was off to a good start for the fourth quarter. So I understand the data, but there are a lot of signs behind the curtain that some of them highly technical, but I'm looking at, for example, there's a lot less there than meets the eye in terms of the monthly employment reports. There was a long string about it's kind of 12 out of 14, which is statistically, if not impossible, definitely of downward revisions. With the report would come out first Friday of the month, prior month, so many jobs created, whether it's 200,000 or 300,000, and then the following month would come out and they say, well, now we created 250,000 jobs, but oh, by the way, prior month we revised down 80,000. It's like, well, wait a second, your 250 was actually 170 and so forth. But that happened month after month after month. The Bureau of Labor Statistics did an annual revision where they wiped out over 800,000 jobs just as a statistical adjustment. And then when you combine that with the monthly adjustments, there were a couple million jobs that disappeared that we were led to believe were created at the time. And, analysts kind of caught on to this and they gave it less and less credence. Now, the most recent jobs report, we saw that the reported number was 12,000, which is nothing. It's positive. A lot of it were government jobs. And when you strip out the government jobs and say, well, what did the private sector do? It was negative. We lost jobs. So employment, as people know, tends to be a lagging indicator. So when you see trouble showing up in the employment markets, you may already be in the recession. You just don't know it yet. I mean, the National Bureau of Economic Research, they call kind of balls and strikes, and they're the ones who decide when a recession begins and when it ends. By the time they declare a recession, it's already over. If a recession is 6 months or 9 months, and it takes them 9 months to make up their minds, it's like the recession started, last January or whatever. Like, well, thanks a lot. We've been living through it. We think we knew that. I'm just saying that, A, you can be in a recession, not even know it. You feel it. It might affect you or your neighbors or your business, but there's nobody waving a flag saying, hey, it's a recession. And B, by the time the scorekeepers jump in, it could already be over. So that's one sign. And then within that, just to kind of parse the numbers a little bit, the vast majority of these jobs are going to non-citizens, some legal, some illegal, but none of them U.S. citizens. And they tend to be, not exclusively, they tend to be at the low end of the wage scale. So what's happening is, refer to illegal immigrants in particular, these are the people working for $5 an hour. They're lined up on the expressway entrances, and you pick them up and they'll come, clean your yard or whatever. But if you have enough of those $5 people, the legitimate worker making $8.50 or $9 an hour can't get a raise. Like the $9 guy wants to get up to $12, but if there's a $5 guy waiting in the wings, you don't get that raise. And likewise, the $15 person can't get to 20 because these low income, low wage workers are dragging down the entire wage scale. And that, by the way, is one of the reasons why a lot of big, well-known companies favor all this illegal immigration, because they're the ones hiring, if not $5, maybe $10 an hour people. So A, the labor statistics have been overstated. B, when you adjust them, the economy is a lot weaker than it looks. The jobs that are being created are going to illegal immigrants, and real wages are lagging. So all of this is very bad for consumption. People are just, if they can barely afford to eggs, bacon, bread, gas, and groceries, and gasoline, demand for gasoline is inelastic. Like, you need it. You want a lower price, but it doesn't matter how high the price is. You have to pay it because you have to get to work or take your kids to school or drive your pickup truck on business or whatever it may be. Then there are some more technical indicators. A year and a half ago, we had what's called an inverted yield curve, meaning when you move from left to right, it was going down. And when it happens, it's telling you something. I think, well, why would I take a lower interest rate on a 5-year note than a 4-month bill? And the answer is that I think interest rates are going to come down. I think we're heading into a recession. In other words, that 4% yield on a 5-year treasury note might look really sweet in a world of 2% interest rates or 1% interest rates. If you go into a recession, interest rates are going to drop a lot. They're already dropping at the short end. So I will take a lower yield, meaning the inverted yield curve. So when 3-month treasury bills were around 5.25, you go out to the 10-year note, it was 3.8. That's the smart money saying, I'll take the lower yield because when we get further out the curve as time goes by, interest rates are going to collapse and that yield is going to look really good. The inversion was a warning saying the recession is coming, but now that it's uninverted, it's saying the recession's here. In other words, intermediate and long-term rates are not going up a lot. They've gone up a little, but short-term rates are plunging. And everyone's saying, oh, the Fed's cutting rates. The Fed's going to stimulate the economy with rate cuts. Nonsense. I mean, the Fed is cutting rates, but that's not stimulus. That's a sign of a very weak economy. When did we have low rates? Well, the Great Depression was one, and we had zero rates from 2009 to 2019, which was a long recovery, but a period of very, very weak growth. Our average annual growth rate for that 10-year period was 2%, which is way below trend, which is closer to 3.5. So, a lot of other signs of liquidity and, labor being not as robust as we've been told, and other signs all add up to a very serious warning of recession. Now, people go, wait a second, Jim, stock market's had an all-time high. It is, but who's to say it's not a bubble? And people always say, you can't call it a bubble. They're really hard to spot. That's nonsense. There's nothing easier than spotting a bubble. Just look at the Nikkei index in 1989, the .com NASDAQ 100 composite in 1999, 2000. Said bubbles are easy to spot. What's hard is knowing when they're going to pop. And you don't want to run out and short the market just because it's a bubble, because you can lose a lot of money being right. I mean, that you might be right that it's a bubble and you short the market, but that bubble can expand and the market can go higher. In my view, that's the phase we're in. It's going to break and break hard. Don't know when. And I'm not saying short the market. I am saying just beware. For a long time, go 5 or 6 years, I said gold could go to $10,000 an ounce. And recently I revised that upward to, you do the math, you can update it, but kind of $23,000, $25,000 an ounce. I should explain what that is. It's not a hard forecast like, buy gold because it's going to $10,000 an ounce. Instead, it's an expression. It answers a question. The question is, what would the dollar price of gold have to be in order to have the dollar backed by gold? In other words, whether you want a hard gold standard or soft gold standard or any kind of gold reference, why are we not in that system? And what would the price of gold have to be in order to be in that system? And the math is fairly simple. We can do calculus, but this is kind of 7th grade math, or at least where I went to school. So basically, take the money supply, and right away you run into problems. Everyone thinks they know what money is. Well, no, the Fed doesn't know what money is. They have M0, M1, M2. Whenever you see 5 different measures of money supply, it tells you right away that the Fed doesn't even know what money is. But anyway, I use M1. M0 is base money. That's the money the Fed prints, but it doesn't mean very much because they print it by buying securities from dealers, and the dealer sends in the 10-year notes or 5-year notes, and the Fed pays for the securities with cash. And that money does come out of thin air. That's not just a metaphor. It does come out of thin air, and they pay the banks. The question is, what do the banks do with it? They give it back to the Fed in the form of excess reserves. So all you're really doing, you're expanding both sides of the balance sheet. You're piling on treasury securities, and you're piling up liabilities in the form of excess reserves. But that money is sterilized. It's not doing anything. No one's getting to spend it. There's no velocity. The money that does matter, the money that does drive the economy, doesn't come from the Federal Reserve. It comes from the commercial banks. And that's M1. It includes bank deposits and so forth. And then we know the amount of gold the government has, 8,133 metric tons. People ask me all the time, say, hey, Jim, who owns the gold? Is it the Treasury or the Fed? And I say it's the Army, because they're both Army bases. I mean, West Point and Fort Knox are. The legal answer is the Treasury owns it, but it's stored in Army bases. And one more assumption, how much gold backing do you want? Now, the hard shell Austrians will say 100%, if it's not, it's leverage or it's not a solid standard. Historically, that's not true. Great Britain, backed up by the Royal Navy, ran a very successful gold standard in the 19th century. They had about 20% backing. At any given time, the Bank of England had about 20% backing for their notes. The United States used 40% backing until around the end of World War II, and then they went to 25%, and they ended up at 0 by the late 1960s. But it was either 40% or 25%, so take your pick, and the British were about 20%. That's what you need to instill confidence. So my math is take 40% of M1, that's the dollar amount of gold you need to have a strong gold standard, divide it by the number of ounces in 8,133 metric tons, and you get a number. And that number today is around $23,000. But it keeps going up. And the reason it keeps going up is that the gold supply is constant and the money supply keeps going up. So again, 5th grade math, you're going to get a larger and larger number of dollars per ounce in order to back up a higher dollar amount with the same amount of ounces. So it's about $23,000. So just to be clear, that's not saying that gold is going straight to $23,000 an ounce. That's saying if confidence in the dollar were undermined and you had to resort to gold to restore confidence, you can't just pick a number. If the number's too low, it's going to be highly deflationary, which is what happened in the late 1920s. So what would the number be? And the answer is around $23,000 an ounce. We know what Trump's going to do. And what he's going to do has been around since 1790. It's called the American system. The American system was invented by Alexander Hamilton. It was supported by George Washington. And over the decades, it was picked up by and expanded in different ways by Henry Clay, John Quincy Adams. Abraham Lincoln was a major proponent of the American system. William McKinley, Calvin Coolidge, all the way through to Dwight Eisenhower. And now there were opponents, the agrarian interests, Jefferson, Madison, they were very much against it. But they failed when they shut down the first Bank of the United States. And at almost the same time, you had the War of 1812. They found out that they couldn't finance the war. They pretty quickly started the second Bank of the United States because that first bank, which was a proto-central bank, had a lot of utility. By the way, the first Bank of the United States, our first central bank from 1792 to 1812, had a 20-year charter. Don't think of it like the Fed. I mean, they didn't print money. They didn't create stimulus. They didn't try to regulate unemployment. They didn't have Humphrey Hawkins. They didn't do any of that stuff, which our current Fed does dismally. It was a pretty simple operation. It was supposed to provide liquidity to commerce on good collateral and good credit and to the government so that they could have a form of money that would get the economy moving. And they did. And it worked very well. But the American system, what was it? It was high tariffs, a central bank of very limited powers to provide liquidity, infrastructure investment, which could be public or private. But the key was that it had to be productive, meaning in the early 19th century, it was roads, canals. In the late 19th century, it was railroads. Today, it might be 5G or infrastructure or digital infrastructure, etc., space exploration, but it had to be of a productive kind or a kind that was stretching the boundaries, and then a strong defense. But again, a strong defense to protect American interests, not to go around the world invading, not to start endless wars, not to conquer territories or get rid of people we don't like, really just to defend U.S. interests. So a strong military with a limited mission to defend America, a central bank with a limited mission, which is to provide liquidity, nothing else, high tariffs to create high-paying jobs, and aid U.S. industry, and infrastructure investment, which had to be productive. That was the American system, and it worked brilliantly. This is how we grew to be a very rich, powerful country. They kind of ran off the rails around 1962 with the Trade Act of 1962. That was when, because the globalists had really started after World War I. So this is Hayek and Mies and the Austrian School and many others who wanted open borders, open capital accounts, and free trade. And the idea was, let the whole world act like one market, have price discovery, drive the price down. That's the most efficient. That's a nice theory. It's completely contrary to fact. There's no such thing as free trade. I'm expert on this, when you get into subsidies, non-tariff barriers, etc. So free trade doesn't exist. Even if you believe the theory of free trade, which doesn't hold up, it comes from David Ricardo's notion of comparative advantage. The idea was, England's better at making woolen goods and Portugal's better at making wine. So it's stupid for England to grow grapes and stupid for Portugal to make wool. Why don't they just do what they do best in trade? And you can demonstrate that mathematically, and the math works. The problem with that is it presupposes that the factors of production are constant, that England's never going to be a good place to grow grapes and Portugal's never going to be a good place to make woolens. Maybe that was true, but the factors of production are mobile. Today, for example, Taiwan Semiconductor, largest, most powerful, most advanced semiconductor producer in the world. That started in the early 80s. What was Taiwan's comparative advantage in semiconductors in 1980? Zero. They had none, but they created it. They used something like the American system. They put government resources behind it. They let it grow. They let it thrive. If you were talented and you want to spin off, start your own company, they said that's fine. They sent Taiwanese students to America. They went to Stanford, then they went back to Taiwan. They were excellent engineers. And then the capital poured in from the West to expand the industry. So capital was mobile, talent was mobile, technology was mobile. So that obliterates comparative advantage because you just go where the best environment is, but all those factors can go with you. And so that's the case for tariffs. It's like, okay, we're going to use government policy to create our own comparative advantage by putting 500% tariffs on Chinese cars. And you're not saying that China can't sell cars in America. What you're saying is you want to sell cars in America, build them in America, and then you can sell them. And Trump's going to tear up, it was NAFTA, now it's the USMCA, but they're going to target the Mexican companies owned by the Chinese because China's like, hey, put tariffs on China, who cares? We, the Chinese, will build them in Mexico and import them duty-free. And Trump's like, no, if you're a Mexican company covered by USMCA, but you're owned by China, 500% tariff applies to you. That's going to shut down Chinese imports. They're going to have to build them here. By the way, the guy behind this big brain is Robert Lighthizer, who will probably be a cabinet secretary, but he was deputy USTR, trade representative in the Reagan administration. Lighthizer is the guy who saved the U.S. car industry from the Japanese invasion in the early 1980s, and he's going to do it again from the Chinese invasion today. And it's one of the reasons Trump did very well with unionized workers. So it's an easy forecast. I can tell you what they're going to do. High tariffs, a lot of infrastructure, high-paying U.S. jobs behind the tariff walls, and rebuild the military, but don't get engaged in a lot of wars. And, trim the sails of the Fed so that it can be, a lender of last resort, but don't try to micromanage the economy.